Mr. Issac, CMD and CEO at Quess Corp. Sir, congratulations. Did you expect such sort of welcome from the equity markets?
Well, thank you for having us with you today again, and it's been quite a listing. As I can see, it's up by about 58% right now. So, but in the public markets now, we have to be used to days of excitement and maybe some depression also. So we have to take it in our stride. We don't want to get overly excited by the listing price, but we're happy to see that the markets have rewarded a company and the investors who've put money into this company. We want to leave something on the table for investors intentionally, and that's played out to plan. So in a sense, the listing price is something that we are very happy about as reaching a goal that we had set for ourselves.
Right. So markets is expecting a lot of growth from the company. Can you just tell us what has been the historic growth rate and what's the outlook for future? Do you see earnings doubling in 3 years? Do you see sales growth of almost 33%, which will lead to better sales and earnings numbers?
So if you look at our company, historically we've grown, we've had a compounded annual growth rate of about 50% across the last 5 years. Out of this growth, about 15 to little less than 20% has come through inorganic initiatives. We expect to continue the M&A work that we've been doing, to add new verticals to our business that we are unable to grow internally through some small acquisitions that we will do and then grow them after that. But the businesses that we are right now invested in see usually healthy growth rates of between 20 to 25% over the last many years. So if you're able to continue that, plus add on a layer of inorganic growth, we'd be happy to, as a company and management, we'd be happy to drive growth rates at about 20 to 25% at least.
Sir, could you just give us the numbers again, because we need to correct them, what we have here. We had your FY16 PAT at 88.5 and FY15 PAT at 67.2%. Could you just correct that for us, please?
Yeah, so our 5-year compounded annual growth rate in terms of revenues has been at about 50%. Growth rate at the PAT level over 5 years has been actually 81%. So that's really the two numbers that you should look at. What you're looking at is 2-year numbers instead of the 5-year numbers that I've mentioned to you.
But as you go bigger, which is happening in your case, I'm just looking at the 2-year number. In that case, the PAT growth is about 31%, right? So, which seems a slight drop. Is that because of increased expenditure of some sort?
No, two reasons in that. One is that we've had 2 assets that we bought, which were turnaround assets last year, MFX and Brain Hunter, both of which were loss-making. So some of our existing profits were in fact depleted because of the fact that we had 2 loss-making assets there, both of which are turned around. So we hope them to contribute positively to our P&L this year. The second is that the numbers for the last 2 years are not entirely comparable, because one is for 15 months and the other one is for 12 months. For the year ending 2015, it was for a period of 15 months, and year ending 2016, it was for a period of 12 months.
All right. Okay. So therefore, the growth would be higher if one gets the exact numbers. So the 81% PAT growth, that's a massive growth. Obviously, as you go bigger, the last time we spoke to you, you were saying that your margins are approximately about 5%, right? It is a volume-driven.
That's right, yeah.
Low margin, I wouldn't say low margin, but modest margin business, largely volume-driven. When you list with a 50% premium to your issue price, I understand that you wanted to leave something on the table. It's not something, it's a massive gift to your investors, I'll have to say. But it also becomes, the burden of delivering becomes increasingly higher, right?
So, people have asked me this question in the past as to what is your approach to getting listed and why would you leave this much on the table, etc. I think you must come back to seeing the basic philosophy of the company. We're building an institution for the long term. So in the long term, we hope to reward shareholders continually. What we've done in the past is is exactly the same thing. We've had an investor here, a private equity investor who was bought out by Thomas Cook / Fairfax. who also made a fair amount of money in the exit. So I think the management is focused on creating value. And while we create value, we intend to ensure that shareholders get rewarded, stakeholders are taken care of in this process. The value that comes for our equity is market-driven. And it's a price that's discovered through market forces over which we have no control on. We will continue to do
while
those
that
things
is true, sir,
are,
it is also true that when you go to the market to raise money, your market cap is something that you can use. Everyone does that. That's one of the things about having a great market cap. Now, that's what I'm asking. That sometimes what happens is that you tend to have to do things because you don't want your market cap to slip. Now, I understand that you just you just sold about 10%. But how independent will you be able to retain so that you have a long-term goal? You buy a company, suddenly your PAT falls and people start saying, oh my God, what has happened?
Yeah, but we are under no compulsion to only take those decisions that will influence market cap. As I mentioned, we are driven to the long term. We will only take those decisions that impact the company's profits and sustainability of its profits over the long term. Close to, between Fairfax, Thomas Cook and myself, we will own almost about 80-85% of the company. So we would be very consistent in our way at protecting minority shareholders' interests because we think they're aligned to our interests to ensure that we create long-term sustainable profits. And we will only take those decisions that are definitely not short-term in nature.
Okay, just for our viewers, let me just quickly recap what you do, and which is essentially if I open a business and you'll be able to provide all the administrative help, everything that I would have to do, and I would not have to hire those people, and you would handle that. Quess Corp would handle that. To me, from the outside, it doesn't look like a high entry barrier business. I mean, in the sense that there would be many smaller players out there who would probably be competing with you on a day-to-day basis, and which kind of tends to show in the fact that the margins are modest. Is growth in this business largely going to be through inorganic moves?
So two responses to that. One is, while at the individual business level, entry barriers may not be too much, at the aggregated level, where you're finding 4 such business verticals, you have no other such business services platform in India which is able to offer such a wide array of services. One. Second is, there is a tendency of client companies to aggregate services to one vendor to reduce the number of vendors that they have to deal with and to ensure that the vendor that they're dealing with is completely corporatized, is structured in its approach, is compliant with regulations, etc. So in all these respects, we stand to gain because we have size, we have scope, we're the largest, and we bring a range of services that nobody else has. So to that extent, we have a set of advantages that nobody else has in the market. And I think that advantage is going to stay with us for a long time because for anyone else to put together these range of services overnight is going to take a few years.
But as you go into more and more services, like let's say, I understand that as you said that you handle payroll, you handled IT. I think the last time we spoke to you, you said that if their AC is not working, even that kind of a service you can provide, or at least are in the process of being able to provide. Now, there would be specialists, right? Let's say I am a quick service restaurant and I hire Quess Corp to handle most of my work. And then there would be a specialist who supplies me delivery boys as they call. Suppose you want to enter that business. Would you then go and buy it out? Because that's a specialist area.
So some of the business that we are in, actually, we've built it ourselves. For example, a managed services business where we do telecom, tower-related RF equipment, installation, maintenance work. We built it internally. We've done 24,000 towers, and that's a growing business for us. Contrarily, another business like IT staffing, we went out and bought. So there are situational decisions, and I don't think one size will fit every decision that we take there. It is in the context of what price we get, what kind of people we're able to get, what is the deal structure, and is it easier to build or to buy? And these are the type of factors we'll consider. while deciding whether we want to buy a business or whether we want to build it ourselves.
So with the 80%, 81% CAGR PAT growth, more than 50% sales growth, obviously that shows that you have massive internal accruals. What was the logic behind going to the market and raising money? Was it just to allow people to exit who were already invested?
I think one point to note here is that none of the existing shareholders have sold. So this is fresh capital into the company. The theme or the central message around our entire fundraising program here has been growth. 80 crores out of the 400 is towards M&A, 160 crores is towards funding new working capital requirements of the company, 50 crores is towards retiring some existing debt, and about 70 crores is for capex, which we think will give us new revenue lines. So we have a great base that we've built up in terms of lines of businesses, and this capital will now help us expand some of the businesses that have adjacencies that we are not present in, and also to fund the working capital requirements of each of these businesses. So it's completely growth oriented.
I know you've had a very busy day, and I can see that you're looking off camera because you have to go, but I have just one final question. And this is that if it is possible for you to give us some more details on the money you said that has been left for M&A and the money that you're raising for capex. Is there any finer details that you can give to us on that?
So in capex, out of the 70 crores that we've apportioned for capex, half of it will go towards Hoffencons, about 30 to 35 crores. Hoffencons requires to buy tools
half
and
30
tackles.
crores, 30 to 35 will go for what?
To Hoffencons, which is our industrial asset management business.
Okay. And the
So
remaining?
in that business, we will go towards MFX and towards our facilities management business.
Okay. And the M&A, what are you looking for right now?
Well, we're looking for a lot of things, but nothing close to fruition yet.
Companies, but what kind of services would that be?
Yeah, I think we'll be happy to enter the security services space because the government has now relaxed FDI requirements from previously it was 49%, now they've dropped to 74%. So somebody like us can actually be in that space right now. Payroll and compliance is another area that we'd like to make an acquisition in. And we'll also like to look at IT infrastructure services where we think there's a lot of juice left still.
All right, sir. Thank you so much and congratulations. Very exciting day for you. Congratulations.
Thank you so much.
Thank you.